The Reserve Bank of India's big growth bazooka lifted the Nifty back above the 25,000 mark, while the Nifty Bank soared to a record high. Friday's rally helped Dalal Street end the week in the green on a positive note. On this week's edition of Editors Roundtable, we decode the RBI's monetary policy, put the spotlight on railway stocks, and also take you through the bitter feud playing out between Donald Trump and Elon Musk. I'm Surabhi Upadhyay. With me, as always, Prashant as well as Nimesh. Guys, what a week,
right? Oh.
Thank God it's Friday.
I know. This week looked like let the Friday come. It was really a hectic week.
Conferences, RBI.
So many blogs, Trump fighting with...
You know what I'm going to do is I'm going to go back to all our episodes and every Friday.
We see the same.
I mean, I think
No, but this time we really felt it. Like this Friday couldn't come soon enough. And when it did, the Friday itself was a bang.
This week also looked big.
Yeah,
because of conferences, blogs, so much happened.
Hectic.
But I think the week itself, I was just doing a wrap for the evening. And there's no point really doing Friday to Friday. Because I think, the day itself defined the week.
Yeah.
And I think when you think about it, when you come back on Monday, you're not going to look at the whole week, what markets did. You're going to pick off in terms of just where sentiment is, where markets are. And all of that has been defined by the RBI. And maybe over the weekend, if something comes from the US with that phone call, etc. But I think the defining moment, the defining day was really the RBI. And so you put that interestingly, it lifted growth. I think it's lifted the Nifty. Yeah. Now it needs to lift
the actual growth as well. That's true. So very quickly, just to sort of wrap this up and why Friday became the defining day of the week. It's the RBI bazooka, right? And the central bank decided to fire way beyond the market's expectations. We went into the event with the expectation of a 25 basis points rate cut. What we got? 50 basis points repo rate cut and a CRR cut and a whole host of other measures as well. For instance, for gold financiers, which makes lending easier when it comes to small ticket gold loans. And we'll talk about some of these issues as we go forward. For the market, this has meant that we are right at the top of the recent trading range. 15 trading sessions, the market has been in a band of about 550 points. The lower end has been about, 24,450. The upper end has been 25,116 to be precise, and we are right there. The Nifty is just about 100 points away from that peak that we hit on the 15th of May. The RBI governor, while discussing the policy and why they have done what they've done, he said that the RBI believes that we've won the war on inflation. It's time to put the focus on growth. And we'll get in Lata to sort of explain some of these steps and what the implications could be. Let's talk about the numbers now. For the week, because of Friday, and thank God it was that Friday, we're up 1% on the Nifty as well. But the mid-cap and the small-cap story anyway was firing earlier in the week. And the final tally is looking so good. 3% almost on mid-caps, 4% almost on the small-cap index. And look at the individual pockets. Real estate stocks, of course, a lot of that was Friday because of the policy action. 9% up on the real estate index. Capital market index up almost 8.5%. So you had specific pockets. Defense was patchy, one day on, one day off. But on an individual stock level, there's a lot of action. And finally, the Nifty is now firing up. The bank Nifty, in contrast, is up 1.5%, finally also hitting those all-time high levels. Now, while we're celebrating the RBI move here in India, let's also keep in context that in general, global markets have been completely looking through all the tariff noise, all the headlines, all the skirmishes and the drones in Russia and in Ukraine and the Twitter and the social media barrage. Markets have been going higher, 1 to 1.5% higher on the US. The Kospi is up, 4.5% this week. The Hang Seng is up 3.5% this week. In general, the sentiment in equities seems to be up. And we'll only hope, equity bulls will hope that the non-farm payrolls data that we get later this evening, that Prashant will watch very closely, that just keeps the good sentiment on and it doesn't kind of spoil the equity party.
Yeah, absolutely.
No, absolutely. I think let's bring in Aman Chauhan into the conversation. He's fund manager at Abacus Asset Management. Aman, great to have you with us here. Thank you for your time.
Hi.
Where will this RBI boost show up most from a stock market perspective? Which today, for example, it was banks, NBFCs, your capital market companies, the Nippon Mutual Fund and HDFC AMC. SBI card was up sharply. So it was all, financials, holding companies for some reason were jumping. But where will the real estate was another? Where will this show up in a big way, in actual way, in a sustained way, durable way? Aman.
I think at least for the next few weeks, it has to be financials, but more so NBFCs than banks. It can also happen in say now mid-sized PSU banks, because you have seen large private banks already moved up. You have seen large PSU banks also moved up. So mid-sized PSU banks, mid-sized bank, NBFCs, that's where I think where the buzz is going to be. Ultimately, what will happen is whatever is not moved up will move up once. Then people will try and realize to which is better way on price to book, ROA, ROE. That will all come subsequently. But for now, once whatever is not moved has to move up once. So today was the first day. I expect something similar to continue next week also.
You know, Digant Haria Aman was with us, and he was saying that banks, institutions with weaker liability franchises, and he named a few names also, RBL and IndusInd and Yes, etc. These may benefit disproportionately, and these are also, I think they also kind of fit what the criteria you mentioned, things which have not done very well in that sense. You talk about PSU banks. Would you agree?
These are more of catch-up trades because for a genuine and justified reason, they are all trading below book, right? But now, when everything else is now moved beyond book, you want to have a relative trade. So in that relative trade, all this fits in. So the mid-tier PSU banks, RBLs, and IndusInd banks of the world, they also see and you can say push up. So it's like tide lifting all boats. So the bigger boats are already there. The smaller boats are now going to follow.
Okay, big boats and smaller boats, but they're all going to go flying, as Aman put it. Aman, coming back to you, but let's go across to Lata now, who in the morning was telling us this is a preview that maybe we should expect fireworks, and I think fireworks is what we've got. Lata, over to you.
Well, since this is RCB week, let me start with some cricket analogies. The governor actually came out and batted like Josh Inglis, didn't he? I mean, who expected so many sixers? A double rate cut, 50 bips, and a 100 bip CRR cut. I can't remember when we last got a 100 bip CRR cut. Was it during the Lehman crisis or something? Even last November, Shaktikanta gave us only a 50 bips. So that was like really mind-boggling innings. But then he just got converted himself into, what do you call it, Rahul Dravid? I know that's my times, but just went back to the crease, as it were, and changed the stance from accommodative to neutral. So what does this mean? It doesn't mean more cuts. It means the August cut has been advanced to June. That's the only way you can read the word neutral. And also, neutral should more likely mean that there are no more rate cuts. You know, there is the chances of a further rate cut and taking the repo to 5/4 now drops very steeply, because I specifically asked the governor that, and he said, you know, you may have a 3.7% inflation cut now, but next year it is 4.5%. So that is exactly what the market wanted to hear. If your inflation, if you are looking at the inflation at 4.5%, then you have to add that 1.5% positive real return. Then you are at already at 5.5%. There is no further scope to cut rates. So chances are the market will get used to that idea. That's about bonds. So the bond rally kind of peters out because of that. It kind of has to stop over there. The other important point that he made is the impact on banks. That's the CRR cut. Immediately, the repo cut is what comes into effect. CRR comes into effect from September. The repo cut of 0.5% not expected, which means about 30% of the loans of every bank suddenly gives you 0.5% less. So it's going to be a bad first quarter for banks as far as their margins are concerned. But it starts improving, because once the CRR cut starts factoring in, then your cost also becomes cheaper, and as the year goes by, all your deposits start getting repriced, and therefore banks are likely to exit the year with a very good margin. What the SBI chairman very beautifully put up as a U-shaped curve as far as the margins are concerned, fall and then rise just as dramatically. That's the story on banks. Exit FY26, very good. And for the rest of the market, the interest rate sensitives, NBFCs, real estate, those depending on consumer loans, even autos for that matter, I think it's a very, very good deal indeed, because we are going to see retail loans actually, getting cheaper and cheaper as the year goes by.
No, absolutely. Lata, thank you very much for that. And I think, important to set the context as Lata did. More money in the hands of the consumer, hopefully, which will come back into the economy. Let's just talk about the other thing, right? Which is sectors which have been zooming higher with regards to what we've seen in the market. Defense is one, and we've spoken about this quite a bit. But the other is railways. And Nimish, you've looked at this in some detail.
Prashant,
What have you found?
Last 1 month, all the railway stocks have been buzzing. Even if you look at the valuation, they look very punchy. But the bigger thing is, if you look at the last 2 years of growth, that is what will surprise the market in a negative way. I'll just go to the wall and explain why I'm saying this. So let me put the data on the wall. If you look at the railway stocks in the last 1 month itself and the kind of rally the railway stocks have done, the chart will come up for you. In the last 1 month, all the stocks have been buzzing in the last 1 month or so. IRFC, Ircon, Railtel, RITES, RVNL. Look at the kind of move in the last 1 month, all in double digits, between 25% to 45-50% as well in terms of the 1 month move. But having said that, they're still down from the peak between 30 to 40%. So they've not hit the peak yet, what we saw earlier this year. But the rally has been pretty sharp in the last 1 month. But the question is the valuation. Now, if you look at the valuation chart for all these names, look at the valuation of all these companies. Ircon is sitting at 28 times 1 year forward versus the 5-year average of 15 times. Railtel is at 47 times now on 1 year forward. RITES is at 34 times versus the 5-year average of 21 times. And RVNL, which is the new entrant in the FNO, that is now trading at 60 times on 1 year versus that 5-year average of just 12 times PE. So that's the valuation picture. Next, the table which is going to come, that's going to surprise and shock a lot of investors. Look at the kind of growth these companies are reporting. On a sales, this is a 2-year sales, profit and EBITDA CAGR. Ircon, just 2% sales growth, negative profit, as well as just 9% or 10% EBITDA growth. Same is the case with IRFC as well. Look at the numbers, 3% sales growth to almost 3% profit CAGR and nothing for EBITDA. RVNL, the stock has been a big mover in the last few months. It's been a negative growth over the last 2 years, and the stock is quoting at 60 times. So that's what I wanted to explain, that earnings have not been supportive in many of these companies. The only stock or only company which has done relatively well is Railtel. That has consistently outperformed in the last 2 years in terms of sales CAGR of 33%, profit CAGR of almost 30-odd%, and EBITDA CAGR of 17%. Even RITES, for that matter, in the last 2 years, it's been a negative. In fact, there has been a degrowth, and the stocks have been buzzing. So, just to put into context, while we've seen a big rally, the valuations are quite punchy, the earnings are not very supportive, and that is what investors should watch out for. There is a bit of exuberance in the PSU basket, even in the rail basket, but when you look at the numbers, it shows you that it's not all good as far as the numbers are concerned. The last 2 year CAGR for someone like RVNL has been negative. Stock is at 60 times and quoting at almost 90,000 crores of market cap. So again, it's for viewers to just take a bit of an informed call that not everything in railway or not everything in PSU is going to do well. And just look at the numbers, and that's a bit of a shocking number that many of them have not grown for the last 2 years.
I'm glad you picked this up, Nimesh, because indeed, the fact that the railway rally started is really perplexing, because it's not like we've seen some mega bids or any order announcements or order wins this week. Let me throw this to Aman.
In fact, just to add to this, even the railway budget, or in the budget, the capex for railway is pretty much been flat for the last 2 years. There has been not incremental new capex that the government has announced.
Yeah.
And look at the kind of valuation these companies are quoting at. I was surprised with RVNL's entry into the FNO market. The stock is in the FNO from this series, 60 times flat growth or a negative growth, and 88, 90,000 crore market cap. I mean, it's really surprising that people are still looking to buy into this. And I missed out the last part on the retail participation in all these companies in last 2 years. The only segment which has seen an increase in the shareholding is all the retail investors.
Yeah,
so from that perspective, one needs to be a bit careful.
Nimesh, you mentioned that Kotak, there's a Kotak note as well.
There's a Kotak note as well. I've picked up
Is there anything on defense in there? Because
not really. This was on railway. But Prashant, that's what maybe I'll work on that as well. So again, initially what I wanted to do was look at all the PSUs and classify into 3 different buckets. Something which has done well but supported by earnings. I think defense to some extent will be backed by earnings as well. Okay, but there are some pockets which are just buzzing, just going up because of the euphoria, without backed by real solid earnings growth.
So actually, let's throw this to Aman. Aman, both the sectors, one by one if you can. Let's start with railways. Defense, like Nimesh is also pointing out, some numbers are very good, some like Mazgaon were disappointing. But let's get back to railways. I mean, did you make any head or tail out of the sudden interest in railway stocks? What's your own, take and positioning on them?
As you rightly said, it's more of retail frenzy in this segment than any institutional frenzy. And I guess what could be the reason was that 1 year back, the segment that was doing well was defense and railways before the market started to correct. Right now, the defense has come back. For the retail guy, he is now feeling that defense has already performed, that has bounced back. Now it is time for the railways to come in. I believe that could be the only reason, because first, rightly so, it's as Nimesh mentioned, valuations are stretched. There is nothing much exciting happening there. There is no news, there is no event, besides the only fact that maybe it's a catch-up rally after defense.
No, absolutely. And I think that's the only rationale that I could think or come up with as well. I mean, nothing else in terms of news flow. On defense, because there's a big debate now, Aman, on defense. I mean, brokers like Kotak, for instance, are raising the red flag on, for instance, some of the shipbuilding stocks, saying that, what really is going to be the EPS CAGR. What's your thought? What do you still like here, and what would you completely avoid?
The EPS CAGR or near-term earnings is still next 2 to 3 years what you're factoring in. When somebody's defense stock is back, factoring the macro story that India wants to reduce import dependence, now with a very hostile equation with the neighbors, the defense spending will go up. Even if the spending doesn't go up, the urgency goes up. So what we wanted to do in 3 years, now we want to do it in 2 years. So near term, the base effect of the earnings growth comes in. That the people are buying for these reasons. They're not buying for immediate EPS growth, because anyway, whether they're shipbuilders or it is a large BEL or a HAL kind of thing, when you deliver is when you make the maximum margin, and the delivery is 2, 3, 4 year cycle, right? So nobody is looking at the near-term earnings that way. So defense is more of a top-down macro approach, that this is the government focus. We are forced to spend more, forced to spend fast, and just import substitution means that these companies can still be 2 to 3x of what the current size they are. And that's what the opportunity is, that's what the excitement for defense is. I don't think anybody is buying for the next quarter or for the next year.
No, fair enough. But I mean, do valuations still offer some support? Even if you take a three-year view, got it? I mean, these are lumpy businesses. These are very large orders that take time to execute. But do the valuations still leave something on the table?
Not much. We don't own most of the defense names that got discussed. So that will give you an answer.
Defensive on defense. That makes sense. Aman, we're going to take a quick commercial break here. We're going to come back and continue this conversation on the other side. Stay tuned.